Hey everyone, today I'm doing some portfolio cleanup. I'm selling off my position in GOF and replacing it with something more stable that can still generate solid income. A lot of people hear the word bond and immediately think low returns and boredom, but I'm looking for something that brings more stability and reliable high income without being overly aggressive. Let me walk you through my thinking. So why am I getting rid of GOF? There are a few structural reasons why I've become less comfortable holding it. First, GOF is a closed-end fund that uses leverage. While leverage can boost returns in good times, it also amplifies losses when markets turn. That extra layer of risk isn't something I want to carry right now, especially when I already have higher conviction positions elsewhere. Second, many CEFs like this rely heavily on return of capital to support their high distribution rates. On paper, the yield looks attractive, but part of what you receive can actually be your own money coming back to you. Over time, this can slowly reduce your cost basis and hurt long-term compounding. Third, closed-end funds trade at premiums or discounts to their net asset value. This adds another variable that can work against you even if the underlying holdings are performing okay. It introduces extra complexity that I'd rather avoid. And finally, when I focus on total return rather than just the yield, GOF hasn't delivered the consistency I'm looking for compared to some of my other holdings. To make this more personal, here's what my actual position looks like. I started this position on June 17th, 2025. Since then, my net cash flow into GOF has been $1,407.87. That's the total amount I've put into this holding over time. Even after putting in over $1,400, the current value sits at just $1,050. The market value has dropped by $357, and after accounting for the $188 in dividends I've received, I'm still looking at a net loss of about $169, or roughly minus 13.5% overall. My money-weighted return on this position is minus 13.58%. For me, this became one of those holdings where the high yield looked good on the surface, but when I looked at the full picture, the leverage, the return of capital, the NAV decay, and the actual results after putting in meaningful capital, it just wasn't performing the way I wanted it to. Sometimes the best move in portfolio management isn't about chasing the highest yield. It's about recognizing when a position no longer fits what you're trying to build and having the discipline to clean it up. On the other side, I wanted to add something that brings more stability and reliable high income to the portfolio. That's why I'm moving into USHY, a short duration, high yield corporate bond ETF. Here's why this fits what I'm looking for. First, it currently yields around 7%. That's meaningful income while still being more conservative than some of my equity-based income strategies. Second, because it's short duration, it has less sensitivity to interest rate changes compared to traditional bond funds. This makes it more stable in the current environment, especially if rates stay higher for longer. Third, it adds real diversification. Most of my income right now comes from a mix of covered call ETFs, BDCs, REITs, and individual dividend stocks. All of these are tied to equities in one way or another. Adding a bond component gives me exposure to credit markets and helps balance the portfolio overall. And fourth, it's more reliable and stable than leveraged products or ultra-aggressive option income strategies. I'm not trying to chase the highest possible yield anymore. I want something that can generate solid income with lower overall risk and more consistency. This won't be a large position. I'm only allocating around the price of GOF for now and probably continue to add more later down the road. But I think it's a smart, measured way to improve the quality and balance of the portfolio over time. Overall, this is a relatively small move, but I believe it improves the portfolio in a meaningful way. I'm removing a holding that had too many structural issues for my liking: leverage, return of capital risk, and inconsistent total returns, and replacing it with something that offers decent income along with more stability and better diversification. I'm trying to be more intentional with my portfolio these days. Instead of always going for the highest yield, I'm also thinking about reliability, risk, and how different pieces fit together across the whole account. Sometimes portfolio management isn't about making big dramatic changes. It's about making small, thoughtful adjustments that improve the overall quality of what you own. If you're doing any portfolio cleanup of your own, I'd love to hear what you're thinking about in the comments. Thanks for watching. See you in the next one.